There's two ways to avoid capital gains and ordinary income taxes when you're building your own house. But if you don't know these two things, it could cost you thousands of dollars in taxes. So position yourself on what you need to take advantage of is super important when you're doing the ground up game in new construction and you're building your own single family home. Let's take a look here at the two items that we need to pay attention to. Number one, let's take a look at capital gains tax. So number one, if you're doing an owner build and you're building your own house, one of the number one incentive that the Internal Revenue Service gives us is the fact that as an individual, you can save up to $250,000 in capital gains taxes. As a married couple, you can save up to $500,000 in capital gains taxes. And this is how. When you go in, you build a single family home. Most people don't have that type of equity to take advantage of anyway. So the biggest thing is knowing, okay, how do you gain that type of equity in a home first and foremost? Because theoretically, people go, well, I just have to buy a house. And if I buy a house, I can take advantage of $500,000 in capital gains. Okay, where does your equity come from is the big question. Like, do you just go in, buy a house, and boom, this magical $500,000 of equity just magically appears? No. And so you have to create that equity. And the biggest thing is when you have a business model that supports the equity upside that you need so that you can take advantage of the capital gains tax incentives that the IRS puts together for us, this is how you do it. So when you go in, ladies and gentlemen, the IRS says if you're an individual, you could save up to $250,000 in capital gains taxes, okay? So when we go in, if you're a married couple, it's $500,000, okay? So when we go in knowing this, how do you go in and create this $500,000 in upside profits and equity in your single family home? So this is how, ladies and gentlemen. Let's say the lot is always going to be about 15% of your single family home price, okay? So if we go in and you're building an $800,000 home, okay? So you have an $800,000 home. And if it's 15%, we take $800,000 times 0.15. That means $120,000 for the lot. If your demographical area doesn't fit this exact business model, it's all percentage basis. So if you're in California where the average median home is $800,000, well, you might be selling homes for $1.5 million. So if you just take 15% of that, that's equivalent to what you're going to maximize the amount you pay for the lot is that 15%. Anything below that, even better. Okay, now that does include utilities. So when we go in, we're going to have about $120,000 for the land. Our build is going to be an $800,000 home. It's going to be right around 2,300, 2,400 square feet. Let's call it 2,400 square feet. The average build nationwide is $141 a square foot. Let's call it $150 a square foot to build, okay, per square foot. That's abbreviation for square foot. So 2,400 times 150. It's going to build a little bit nicer home. That's $360,000 in your build cost. If you're getting a mortgage on it, your construction loan, I would always do a one-time close loan. The one-time close loan means that you're doing what's called a construction to perm loan. That means that you go in, you're doing a construction loan to permanent finance, which means that you only have one set of closing costs, which will save you anywhere between $5,000 and $10,000. If you do a construction to perm loan, it'll save you on the back end and on the front end. And so when we go in, guys, we're going to have about $25,000 in overall financing fees to get this house done. It's a 6-month build. If you're doing an owner build for yourself, there's probably a lot of emotion going into it because you're picking trim items, you're picking flooring, you're picking carpet, you're picking cabinets, you're picking countertop, you're picking fixtures. What color are these fixtures? And all of those emotions are going into this build because it's your home. And so it might take you 9 months. It might even take you a year to do. So if we have $25,000 in debt service for lending, this is the variable most people forget to tally into their overall bill. Don't forget about debt service. It's your most expensive, non-considered amount of expense in the entire bill. So if we go in, we look at our debt service, we're going to have a total out of pocket, $120 plus $360 plus 25. That's $505,000 total cost, okay? Now, when we go in and we look at this, now we have $300,000 in upside equity, okay? Let's say that you live in that home for 3 years, okay? It takes 2 years. This right here is contingent on taking primary residency for 2 years plus, 2 years or more. Okay, now we go in, provided we do 2 years in that home. Let's say that the house goes up 3% annually. Okay, the value of that home goes up 3% each year, just based on living wage and normal economics. So if we live in that house for 3 years, we take an $800,000 home times 0.03 times 3 years. That's a $72,000 increase in valuation from the time that you actually buy it to the time you sell. So now we have $872,000. 3 years later, we sell this home for $872,000. Okay. Now, you've also paid down your mortgage a little bit, but that's already still money out of pocket. But we have this $300,000 in equity plus the $72,000 in equity. You sell your home 3 years from now, 2028. rolls around, you sell. Your net is going to be a total of $372,000. You pay $0 in capital gains taxes. And that is because of this right here, okay? It's not $500,000, it's up to $500,000. But if you're a married couple, you could take $372,000 tax-free, okay? And that, ladies and gentlemen, is the first way that you don't pay taxes on your physical personal home. Now, number two, ladies and gentlemen, is going to be through what we call cost segregation, okay? Now, cost segregation is slightly different. So there's two ways to look at this. You can take a look at this as an individual running a small sole proprietorship or a small business, or you could take a look at this as a bigger business model. Whichever you want to take down is entirely up to you. But now we look at it from an ordinary income tax perspective, okay? This is ordinary income, from ordinary income. Now, when we look at it from a business, it's not capital gains taxes because we're not looking at it as a long-term hold. Now, if we do look at it as a long-term hold, there's two different ways to consider this property. Now, when we go in, let's take a look at it from ordinary income and let's take a look at it from capital gains, okay? Now, if we go in and just like what we did before, we look at this from a capital gains perspective, right here with 372. We have the same number, same scenario, same everything. Nothing changes. We're going to keep the exact same scenario. Now, we go in and from a capital gains perspective, we could put this in as a business under an LLC, okay? So we could take the ownership under 1, 2, 3, 4, A to Z, LLC. Okay, this is our LLC. Now, we go in and we have this LLC, okay? Now, you go in, you lease it to yourself, okay? Okay, you lease it to yourself. Let's say you're leasing it for $4,000 per month, okay? Now, provided you're not using the whole house to live and work out of, but let's say you're using the vast majority of your home to work out of. Let's say that you have a tractor, you have some few components that you're doing at your house. Let's say that you're working from home, you're utilizing a percentage of your home. You can write off this lease or a good proportion of that lease, depending on the proportion of the home that you're actually utilizing for workspace. And so you can write off a good proportion of that. One of the big mistakes most people make is that they think that cost segregation is only available for those that own commercial property. That's not necessarily the case. You can cost segregate a residential property provided that it's an investment property that you have under your LLC. So if you have it, you can even have the loan under your own personal name, and then you can do a lease back to the home, and you can actually have the deed to the house under the LLC. Because the note and the deed are two different documents. And what the IRS is looking for is who owns the home. And as long as the owner of the home is your LLC, it's deeded to your LLC, how the finances run through the books and the lending gets placed is all accounting, okay? Now, I recommend that you guys talk to and consult with your CPA and your accounting for more direct information on how to structure that correctly. That's not the whole point of the video today. The whole point of the video today is to understand the tax benefits that you have owning a single family home and how to take advantage of not having to pay income taxes or capital gains taxes on that single family home. And so when we go in, ladies and gentlemen, we have an $800,000 asset. We cost segregate this, $800,000. We can't cost segregate the land. So now we have the $120,000 that we actually paid for the land right here. The IRS says you can't depreciate land because God's not making any more of it, but we still have a $680,000 asset that we can cost segregate and write off. So now we go in, we write off $680,000 tax-free, and this goes against your ordinary income. So if you are writing a check to yourself for $4,000 a month, and this is a pass-through entity, an LLC, you can write off the $4,000 that you're paying to yourself and have no income tax liability on this $4,000. Utilize it as a tax write-off. You can utilize this as a tax write-off, and you're doing all of that tax-free. Now, this won't be completely tax-free because this portion of the home that you're utilizing for business is the portion that's actually tax deductible. The portion you're using for yourself is not tax deductible, but the income, the $4,000 that you're paying to your LLC is, because that now becomes earned income, but it goes against this 680, which is now tax deductible, and it becomes tax-free income. What's cool about this cost segregation is this never expires. So if you only have a net taxable income of $120K per year, that's $120, $240 480. So you have 5.5 years if you're making 120 a year where you can go in and pay no federal income taxes on any earned income. It does not matter if you earn that income as a police officer, as a nurse, as a clerk at a grocery store, as an engineer, as a doctor, doesn't matter. Wherever you earn this income, it becomes tax deductible because of this cost segregation. This asset, you just land up leasing it either to yourself. When you're done with this asset, now you go in and you lease that asset to somebody else and you buy and hold these assets. And that's where this is a buy and hold play for long-term cash flow. So for those of you guys that do not have the desire to sell your home, keep it. The house that I built 18 years ago, we still own it today. We were going to sell it and we decided just to lease it. We had it paid off. We didn't have a mortgage on it. We sold it. We collect over $3,800 a month on rent from it, and it's just an extra $3,800 a month. We landed up depreciating that house down to almost nothing, so we took the tax write-off. To be able to sell that house now would cost me more money than I would make in equity. It's not even worth it. So now I'll just keep it, take the $3,800 a month in rental payments on it, because once I sell that house, I have to recapture these gains. That's where this comes back into play, up to $500,000. Only problem is I took $680 in tax deductions off this house, so now I have a tax liability, even if I had it for more than 2 years, of $180,000 in tax liability. That means that $80,000 of that money has to go back to the IRS. When we depreciate these down, it's a long-term hold play. And the only way to get around this is to scale up. And that's where the multifamily game comes into. So when I talk about you going in and actually turning this into a real business, what I tell people is you can utilize this as a short-term solution to a long-term problem. The long-term problem is that if you're doing multiples of these and you have 1, 2, 3, 4 years of redundant builds for 1, 2, 3, 4 years, and now you continue to do this, you're creating a beast. And when you create a beast with tax liability on the back end, that tax liability has to be dissolved someplace. So once you go into a place where you can't do single family homes in magnitude to be able to offset the capital gains on them, that's when you get into multifamily, multi-unit real estate. Because multi-unit real estate has a larger dollar valuation, the cost segregation is going to be bigger. These things produce cash and they cash flow forever. And so you position yourself in a place where you don't ever want to sell these assets because you've taken the tax liability off of your shoulders. Now just keep them and live off the rents. Like my old single family home, it's not worth selling anymore. When we built that house back in 2000, we landed up paying $275,000, another $75,000 in, we're like $350,000 into this house. The house is worth $600,000, $700,000 today. We sell that today. We don't live in it as our primary residence. We recapture the gains that we took on that house. We're going to land up paying more in taxes than what our base was in the initial purchase. So do you keep it and hold it, or do you sell it and take the gain? For us, it's worth it just to keep it, not capture the gains, and just keep it for the cash flow. Ladies and gentlemen, for more content just like this in the real estate industry on how to go out and profit from single family and multi-unit real estate, click and subscribe to our YouTube channel, smash that thumbs up button, continue learning and cramming your brain with great information, and continue to compound your success. Until next time, I'm going to recommend a couple videos for you to watch. Click and subscribe, and we'll see you on the other side.